again to yourselves. So, excuse me. What we're going to do today is continue on from where we left off last week, which was 3/4 of the way through topic 6. Sorry, I just got a bit of a sinus problem, getting over a cold. So, where we left off, we were looking at the contract specifications for the Singapore crude oil futures contract. And the reason why this is important here in Australia, but also in most of Asia, is because, at least Southeast and East Asia, is that it establishes the petrol price that you pay at the gas tank, at the petrol station when you fill up your car. So even in the news here in Australia, you'll hear once in a while that during the news they'll say, oh, and crude oil futures prices have gone up in Singapore. And everybody knows that means in about 1 week's time, petrol prices here in Australia are going to rise. Why? Because, of course, petrol is a derivative of crude oil. And if we want to know what future prices of crude oil are going to be, then what better to look at than the futures contract, okay? Not the spot contract. So, Singapore itself does not produce any oil. It gets its prices from Dubai and Oman, which is in the Middle East. And a contract is on 1,000 barrels. And I think I mentioned last week that it's roughly 250 litres for 1 barrel. So these are very large contracts. Each contract lasts for 6 months before another one is rolled over. So if you have one in January, another one will be created in July, so you can roll them over constantly. Okay. Now, what I was going to do is give you an example of how margin accounting functions. So margin accounting is also called mark-to-market accounting. Sometimes it's also referred to as daily settlement. They mean all the same thing. Can someone tell me why do we have margin accounting in futures markets? What's the reason for it? What's the purpose? You're looking at me, so maybe you have an answer. No? Well, I was teaching the undergrad students the same thing, and I got exactly the same reply. So, not exactly, but you are on the right track. You're close, but that's not exactly the right answer. It is something to do with default risk. So what's default risk? Yes, so basically with a futures contract, as you should know, there's two parties, right? There's one that's taking the long position and the other that's taking the short position. And they basically leads to what we call counterparty risk. Counterparty risk is also sometimes referred to as default risk. It means if you've gone short and you're ready to deliver something, but the other person's run away, then you've got no contract. So default risk is reduced when what happens?
When there's the risk.
Sorry?
You reduce your risk when there's the, so that they will restrict their loss to just a day.
Who's restricting their losses?
The exchange.
That's the answer that I'm looking for. So you are not actually reducing the risk of default. If someone wants to default, they will default, right? There's nothing you can do about it. What happens though is that if you exchange, if you trade in an exchange, there is no default risk. Why is there no default risk? Even though I just said people can run away regardless.
The exchange takes over.
That's right, the exchange takes over the risk of default, right? That's the benefit of trading in an exchange. So, this is getting closer to what I'm looking for in terms of the answer. What is the purpose of margin accounting? It's to reduce the cost of default risk for the exchange. This is a very subtle point, but you need to understand why it exists. Margin accounting is not for your benefit. Daily settlement is not to help you. In fact, it's a hindrance. It's a cost. Why can I say daily settlement is a cost for traders? Why would traders not prefer to have a daily settlement? So, when you buy a futures contract today, how much do you pay for it? Nothing, right? But with margin accounting, what do you have to do? Yeah, you have to place a deposit, right? A margin. So, on any given day, if you're losing money, you have to deposit money. You need to have some liquidity, cash available to deposit in the margin account. This is a cost to you. You'd rather not do that. So, there is a cost to trading in futures markets, which is that you must have some form of cash liquidity to make payments into the margin account. This is a disadvantage for you. The reason margin accounting exists is not for your benefit. It's for the benefit of the exchange. Because if the exchange has to cover default risk, it would rather try to minimize the cost of that, right? So if you have daily settlement practice, what's the maximum loss that the exchange has to cover? What's the maximum loss the exchange has to cover if you've got daily settlement practice? I'm not looking for a dollar value. I'm looking for a time value. You have daily settlement, and every day any gains or losses that traders make have to be transferred. What's the maximum loss that an exchange faces if one party reneges, if one party disappears? Yes. Did you say 1 day? Yes, you are correct. 1 day, right? So you minimize the risk for the exchange to 1 day's worth of losses. That's the purpose of daily settlement. So if you get a question like this in the exam, remember that the reason for daily settlement practice is not because it reduces default risk. Default risk always exists. It just reduces the cost of default risk for the exchange. Okay, so if we have a look at an example, and this is taken from the Singapore Exchange website. Assume that a trader has $10,000 US in their margin account, and there is an initial and a maintenance margin for trading Singapore crude oil futures of $1,500 and $1,200. Now, because on the first day the trader expects that crude oil prices are going to rise, he's going to buy 5 futures contracts. And let's say each futures contract is on $30 a barrel. So remember, when you basically price a futures contract, there's a multiplier, right? The multiplier here is basically how many barrels the contract is on. How much is each contract on? How many barrels? 1,000, right? Okay. So you've got $30 a barrel, and one contract is on 1,000 barrels. The initial margin required, therefore, is going to be 7,500. That's 1,500 multiplied by 5, because you've got 5 contracts. The maintenance margin is going to be smaller. It's $6,000. That's $1,200 multiplied by 5 contracts. Let's say at the end of the trading day, the futures price per barrel for crude oil goes up to $31. That basically represents a $1 unrealized profit, right, per barrel. So, the unrealized profit in total value is going to be $1 multiplied by 1,000 multiplied by 5. Can someone remind me why am I multiplying by 1,000? That's the contract, right? The contract specification. So that gives me $5,000 on the first day. Now, the trader has a choice. Because that money is deposited into the margin account. The trader can at that point in time decide to take the money out and go out at night and spend it on drinks or whatever they want to do, or you can leave it in the account. Let's say the trader decides to leave it in the account. So you had $10,000 and now you've got $15,000 in the account. The next day, crude oil prices fall because of bad news. So they've now gone down to $29.50. That represents a $1.50 unrealized loss per barrel, right? It was $31, now it's gone down to $29.50. So the unrealized loss is $7,500. So at the end of the trading day, at daily settlement, the exchange will take $7,500 away from the margin account that currently has $15,000 in it. So that leaves you with $7,500 remaining. So now you've got less money than you started off with in your margin account. Now, the question is, does that lead to a margin call? The answer is no. The reason being, as we talked about last week, is that there is a buffer zone between the initial margin and the maintenance margin. As long as you have enough money in your margin account above the maintenance margin, there is no margin call. So our maintenance margin value is at $6,000. The amount of money we have in our margin call is $7,500. In other words, there is no margin call. So on the third day, unfortunately for the trader, futures prices continue to go down. They've reduced by another 50 cents. So this is a 50-cent loss at the end of the third trading day. That 50-cent loss represents a $2,500 total loss for the portfolio of 5 futures contracts. So the exchange takes away another $2,500 from the $7,500 in the margin account, leading to $5,000 remaining. This, of course, is below the maintenance margin, right? The maintenance margin requires that you have $6,000 in there. You only have $5,000. So what happens is that you'll get a margin call. The exchange will contact you and say, you need to deposit more money into the margin account. If you don't do that, what do you think is going to happen? If you don't deposit more money into the margin account, what is the exchange going to do?
Sell your contract?
Yeah, they will sell your contracts. Even if you don't want them to, they will do that. They will get rid of your position. So, in order to avoid that, there are 2 things that you can do. You can either top up your account to the initial margin level, or you can liquidate all or some of your contracts. So rather than let the exchange do it, you can personally liquidate some of your contracts. So in the first instance, if you decide to deposit money into your account, you have to put money in back to ensure that you go above the initial margin. So if you're down here at $5,000, you have to deposit $2,500 to take you back up to the initial margin. So every time you get a margin call, you must put money back into the margin account above the initial margin. Not the maintenance margin, but the initial margin. The alternative of selling your contracts is that, well, of course, if you sell 1 or 2 contracts, you're naturally reducing both your initial and your maintenance margins. So you can continue to sell them. In this case, you need to sell 2 in order to reduce your total maintenance margin so it goes below $5,000. If you sell 2 futures contracts, your new maintenance margin will be less than $5,000, and so you don't get a margin call. So those are 2 options that are available to you, 2 choices. Two days before the contract expires, you have something what's called the position day. It's the day that the person who has taken a short position gets a call, or is communicated from or to by the clearinghouse. And the clearinghouse rings basically the short up and says, hey, get ready to terminate your contract. Make sure that you have the goods that you're going to promise to deliver. The day before expiry is referred to as a notice of intention date, when the clearinghouse then also contacts the person, the individual who's gone long, and say, get ready to pay because the contract's about to expire. On the termination date, payment is due. On the termination date of the futures contract, the payment is due. However, the delivery date may be something completely different. For financial futures contracts like stock futures, index futures, interest futures, then yes, delivery is the same in terms of date as the termination date. That's not the case for commodities. If you're, for example, trading wheat futures, then when the termination date occurs, you, if you've taken a long position, must pay the person who's gone short, but the delivery of the goods may happen sometime a month, sometimes even 2 months after the termination date. Why? Because they have to be delivered to a warehouse, then you have to pick it up, there's logistics in terms of transportation. So it's important to remember that the actual delivery day for commodity futures is not the day of termination of the futures contract. Most contracts are not delivered, but rather parties take offsetting positions prior to delivery. Or should I say, that's actually not technically correct. They take offsetting positions prior to termination. Why is that? How can I make that statement? Why are most contracts offset prior to termination? What does an offsetting position mean? Anyone? Ah, you've looked at me. What is an offsetting position? Sorry? Not exactly. Anyone else? Say it again? Yeah, I mean, that's like what the lady said down here. You're both a little bit right. It's not exactly the best way of phrasing it. In an exam, you need to write something a little bit more. Basically, an offsetting position means you take a reverse position in the contract you hold, right? So if you've gone short in the position, it means you go long. If you've gone long, you go short. So you try to offset your position so your net position is zero. Okay? So why would most futures contracts, people who are trading them, offset their positions? What does that tell you? It tells you something quite important. Are they interested in holding the good? No, right? They're not interested in holding the good. They're speculating. They're speculating on prices. These are speculators in the futures market. They're not interested in delivery. So you have different types of people trading in a futures exchange. You have hedgers, you have speculators, you have those who basically want to take delivery of the goods. So if you're a farmer, you're going to want to hold the contract to expiry, right? If you want to get rid of something. If you're a speculator, you're just thinking price is going to go up and down, trying to make money on that. You want to get out of the position before. Otherwise, you're going to have to take delivery, right? You have to take delivery of the goods. You don't really want that. Okay. So what this basically tells you is that nowadays most traders on any given day are speculators in a futures market. If you had a look at the video that I showed last week, you would have noticed at the beginning of the documentary, they showed you a live pit where people were trading by making sort of like hand signals of what they wanted. That type of thing doesn't exist really anymore, except for in the Chicago Board of Trade and the Chicago Mercantile Exchange. The exchange basically runs what's referred to as an open outcry system. As the name suggests, you're crying out your orders, right? You're shouting out your orders. So if you go back maybe 30 years ago, this would be the standard way, maybe, 30 years ago, that would be the standard way in which you actually would trade. Every exchange would have a floor, a trading floor, and you would actually wear a blazer, a colored jacket that stands for the bank that you're trading with. So it might be yellow, blue, green, whatever like. And basically you would trade face to face. That doesn't really exist apart from these two exchanges and maybe a couple of others around the world. Pretty much all exchanges here in Asia and Australia are automated. That basically means they're very sterile. The reason being, if you're a trader nowadays, compared to what happened a long time ago, is that you will basically be sitting in front of a computer looking at the prices coming in, and you're just basically typing in buy and sell. So it's a little bit more boring than what it used to be, okay? It used to be far more exciting. It used to be like going down to a grocery market, a vegetable market, right? And you hear all the grocery store owners shouting out what prices they're willing to sell their tomatoes for. So, in fact, if you go back many, many years ago, 50, 60 years ago, if a bank was trying to find a good trader, guess where they would go? They would go to a grocery market. Why? Because you needed someone who could shout and someone who could think very fast on their feet. Because if you hear another grocery store lowering their price for their tomatoes, you have to know if you can do that as well, but still keep above the cost of what you're selling them for, right? So you need people who can think very fast and actually can deal face to face and be a little bit aggressive as well. So years and years ago, banks used to go and find traders in grocery markets, literally. That, of course, has completely changed. Now, basically, you need a degree and you have to basically sit in front of a computer. You have to know how to program. So things have changed a little bit. So it is interesting, though. So the reason why some markets still operate an open outcry, like the CBOT, is because there is a preference for it when you want to work out how scared the other person is. If you're in front of a computer and you're trading with somebody in another office, right, on the other side of town, you don't know how desperate they are to buy or sell the good. But if you're in front of them, you know, right? You can see if they're starting to sweat, right? If they basically want to get off of a position. So there is a benefit from face-to-face trading. Okay, so you've got open outcry and automated orders, of which automated orders basically is 95% of what exchanges operate around the world now do. Futures contracts are also preferred to the underlying market because they generally involve lesser transaction costs. Transaction fees tend to be less, and they are highly liquid. How can I say, well, let's talk about liquidity. They're very highly leveraged. Why can I say they are leveraged position? They're leveraged because you don't pay anything for it, right? You pay everything in the future. So basically, you don't need any money now other than just to make sure you've got enough money in the margin account. So like options, in fact, even more so like options, it's a very leveraged position which gives you lots of flexibility to take positions even though you may not be able to currently be able to afford it. When you trade, and this will be useful because you will have to participate in a virtual trading exchange soon. Gary Tang is going to explain a lot more about that. You'll be trading futures contracts, and it is important to understand how trades are settled. When you place an order into the system, whether they are actually transacted, whether your order is successful or not, is based on what we call a price and time priority basis. What does that mean? Well, if you have, for example, two orders to buy the same thing, but one order to buy, let's say, stock XYZ is at $5 and the other order is at $4.90, then of course the order that has a higher price gets the deal. So the $5 gets transacted before the $4.90. If two orders come into the system at the same time, and they're both at $5. No, I'm sorry. If two orders come in priced at the same value at $5, it's the order that gets into the system faster that gets transacted first. So that's a time priority. So when you're trading, you have to think about both how long it's taking you to put in your orders, because if you take too long, then you're going to be at the bottom of the list, and also what price you're offering. The higher the price you're willing to buy, and the lower the price you're willing to sell, get preferences. So all orders are ranked according to price and time priority. So this is not that interesting, but all I'm basically showing you here is that if you look at Singapore futures, because I gave an example of the crude oil futures contract before, or the ASX, so Australian Stock Exchange, which now trade futures contracts, you can see that on an annual basis futures contracts rise. So they're in the hundreds of billions in terms of volume trading. So it's a very large market. The Australian Stock Exchange now owns what used to be called the Sydney Futures Exchange. It bought it up. So in the Australian Stock Exchange you can trade options and you can trade futures contracts. Before that was not the case. If you wanted to trade futures, you have to go to the Sydney Futures Exchange. The clearinghouse looks after the inventory of who owns what, and all of this is regulated. And the regulator is the Australian Securities Investment Commission, so ASIC. So every stock exchange around the world will have a regulator that's basically pretty much government run, and they determine how things should be done. Now, just to give you an example of the different type of products that are available around the world, I've got here again the ASX and the Singapore Exchange. Here in Australia, for example, you can trade government treasury bonds, or government bonds. You can trade probably the most important futures contract, financial futures contract here in Australia, which is the SPI contract. I'll talk a little bit more about that in a second. The special price index futures contract. You can also purchase individual share futures contracts. Unlike options, you do not have many share futures contracts. So with options, you can purchase option contracts on many different types of stocks. That's not the case with futures. Maybe the top 20 stocks here in Australia have share futures on them, but that's about it. And that's quite common. So here, if you look at the United States, for example, which will be the largest market, only the top 500 stocks, maybe not even that, would have futures contracts on there. And there are tens of thousands of stocks, so we're only talking about a small proportion of stocks actually have futures contracts on them. So next week we're going to talk a lot more about how do you use index futures to hedge individual share futures positions. The reason being, if you cannot find share futures, you must use an alternative, and the alternative are index futures contracts. So I'm going to explain how you actually use index futures to hedge individual stocks. Now, of course, another big part of futures markets are the commodities sector. And here in Australia, wool is very important, and so, of course, as you can imagine, there are different types of wool futures contracts. You can also trade wheat, which is also a big market here in Australia. And then I've also listed one as a little bit interesting. You can trade electricity futures contracts as well. So about roughly 10 years ago in Australia, the electricity market was deregulated. So that basically means electricity companies compete with one another for you to sign up, for you to get electricity from them. And they sometimes want to be guaranteed what price they have to pay for electricity in the future. So they're going to be trading these electricity futures contracts for both what we call base and peak load. In Singapore, you have a very different setup. Singapore gets most of its customers from abroad. They're not local customers. So the bulk of traders in Singapore, demand is coming from abroad. And what do they trade? Well, there's a little bit of single share futures, but there's a very big market, what I want to highlight, in index futures contracts from places around the world. In one location in Singapore, you can trade Hang Seng index futures Japan Nikkei 225, the US S&P 500 futures, and a list of a number of other countries. They're major exchange indices, all in one place. The only other exchange that does this type of thing is Hong Kong. So Hong Kong and Singapore are constantly sort of like battling, competing with each other for the market of offering exchange index futures contracts. So let me ask you this. Let's see if you can have a guess why this might be the case. What's the benefit of being able, who's going to be interested in trading all these different type of index futures in one location? What's the benefit of doing that? That's right. I mean, if you are, for example, a hedge fund and you want to design a diversified portfolio, you don't have to buy stocks in Japan, then you go and buy some stocks in Taiwan, in the US, in China. You can go to one place in Singapore and take index futures contracts, which has the added benefit of you not having to needing any money, right? You just have to make a margin payment. So in one location, you can take positions from around the world and very, very quickly and easily plus cheaply establish a diversified portfolio. So that's the benefit of being able to trade index futures contracts from exchanges around the world. So here in Australia, the major index, financial index that people focus on and that we're going to be looking at, particularly when it relates to the equity market, is the SPI 200 index futures contract. The SPI stands for Special Price Index, but really all it is the index future of the ASX 200 index. The ASX 200 index, its futures contract is called the SPI 200. That's basically it. And it has roughly a 90% market capitalization of what the listed firms in the ASX are worth. Now, just like with options, there is an index multiplier. The index multiplier for the SPI 200 is $25. So one index point equals $25. So if the index, let's say, is currently at 3,200 points, that means that the cost of one futures contract is $80,000. So, just like I talked about with crude oil futures, and last week I highlighted that these futures contracts that are traded around the world, they're not for individuals like you and me. The reason being, you're dealing with large sums of money. One index future is worth tens of thousands of dollars. It can be even hundreds of thousands of dollars. So, you're talking about large amounts of money. And here I've got a contract specification. I won't spend too much long on it for the futures contract, the SPI 200 futures contract. On the left column, on the furthest right column, you've got actually futures options contracts. This is something that I'll talk a little bit more about in a couple of weeks' time. This is a derivative on a derivative. So it's an option on a futures contract on the stock. So we'll talk a little bit more how that functions later on. But here we can see, just for the individual futures, index futures contract, the underlying is the ASX 200 index. And it's worth highlighting now that, particularly as I go on to the next topic, whenever I talk about the underlying, when I'm referring to it in the context of a futures market, it's called the spot. S-P-O-T. So the spot is the underlying for the futures contract. So you've got the spot market and you've got the futures market. So the spot is the ASX 200 index. Contract size, $25 per index point. A contract cycle, 6 contract months. So every 6 months a new contract is created and another one ends. Tells you the last trading day, which is the last business day of the contract month. And you've got daily settlement, how that's worked out, and what happens during the settlement price at the expiry date. Good. Here I've got an example of how futures contracts are printed. This is from the Australian Financial Review. This is again for the SPY 200, and you can see for convenience it's got in brackets what each point represents. It's $25 a point. You've got the different delivery dates, so June, September, December, March, June, September. So you've got one that goes way out for another year. You've got the price, the previous price of each of these contracts. You've got the first open price of the day, the high price of the day, the low price, and finally the closing, the settlement price. For convenience, it also calculates, tells you what the change has been in points between the previous close and today's final close. That turns out in our case to be 45 points. So there's been a 45-point change. This is important for us because if we've taken a long or short position, we want to know whether we're going to receive money in our margin account or whether we're going to have to pay money. So if we've taken a short position, we're going to have to place money in the account, right? Or we're going to have money taken away from us at least. How much is the 45 points worth? Well, it's telling us here it's $1,100. So I can expect $1,100 taken away from me in my account. What's interesting, if you look at trading volume, is that as you go further away in terms of the termination date extends, basically, trading volume declines. Does anyone have an idea why that is? So basically it's telling us that the largest amount of trading volume is for the contract that's just about to expire. What's the reason for that? Any guesses? Which type of contract would be harder to work out what the final price is going to be? The contract that's just about to expire or the contract that's going to expire in 1 year's time?
Contract about to expire.
Yeah. So basically it's easier to work out what likely the price, the future price of the spot is going to be in 5 days' time than it is going to be in a year's time. So people are more happy to speculate and trade contracts that are going to shortly expire. There's also another reason why you have a large trading volume for contracts that are just about to expire. What is that? It's something that I highlighted earlier this morning, relating to offsetting positions. The bulk of traders in futures exchanges now are what type of traders? They're speculators. Do they want to hold the position till delivery? To termination? No. They want to get out. They want to offset. So suddenly, as you get close to termination, they're closing out their positions. They want to get out. So you expect, of course, trading volume to pick up for that reason as well. Okay. There are also different types of other forward contracts that I have not talked about in this particular topic, but do exist. For example, you've got forward sales and forward purchases. These are basically retail contracts that are offered when you go to a retail store, electronic store, or a clothing store to buy or sell something. So, for example, a forward sale assesses the income being derived when the item is delivered to the purchaser, whereas for a forward purchase, deductions are generally made when the delivery of the asset takes place. So basically, it's about making a decision now about taking delivery in the future and whether you pay for it now or pay for it in the future. So these are contracts that are not traded in open exchanges. There, as I said before, for retail stores and trading stores on a regular basis. Okay, so that pretty much concludes topic 6. So I'm going to make a start on the next topic, and the goal is to finish it today, which we should quite easily be able to do. So all I've done so far really is introduce you to what futures markets are about. What we haven't looked at is how we price them. So I did sort of allude to how we would price futures contracts last week. But can anyone remember how would you work out what the value of a futures price would be? All right. Well, I'll go through it again. What we're going to look at are some properties of forward and futures prices, sort of a recap of what we've just looked at, and then have a look at the actual pricing model. So, it's important to highlight, because I'm going to show you the differences between forward and futures pricing, to understand where that difference arises from. They're basically the same thing, apart from the fact, of course, as you already know, forward contracts are over-the-counter contracts, right? They're not traded in an exchange. And because of that, they are non-standard in terms of their contract specifications. They're just between two parties. Whereas for futures contracts, they are standardized. So one futures contract on one commodity is going to be identical to another one. They have the same contract specifications. There's only going to be one delivery date for forward contracts. But of course with futures, as we've talked about before, you have delivery cycles, right? So you can roll over your position. Forward contracts are settled at maturity, whereas futures contracts are settled daily. Why are they settled daily? Yes, because of margin accounting. And finally, forward contracts tend to be delivered and a final cash payment is made, whereas futures contracts are generally closed out before maturity, right? Because people are speculating, they offset their positions. The main difference, as you can see here, between the two is that one, of course, is specialized, the other is general, and of course one has daily settlement practice and the other one does not. And that leads to differences in how we value them. So before we look at valuation, I now want to bring into the picture another very important concept about how futures and forward contracts basically function. It is possible at any point in time for the futures price to be above the spot price, or for the spot price to be above the futures price. Either of these situations is possible. And in fact, on a regular basis, it's quite common to see the spot and the futures cross over each other. That's also very likely. Whenever the futures price is above the spot price, we call that the market is in what's referred to as contango. You don't have to worry about writing it down just right now, because I'm going to talk a little bit more about that later on. But basically a market that's in contango is where the futures price is above the spot price. A market where the spot price is above the futures price is referred to as backwardation. So we're going to study why you might have a contango market versus a backwardation market. There are reasons for it, so that's what we're going to try to understand. The other thing that is notable in both of these figures is that at the time of termination, which is represented by the end of these squiggles, the futures price will always equal the spot price. At the time of the futures contract termination, the futures price will always equal the spot price. Does anyone know why that is? What could be a reason for it? If I buy a bottle of water today, when do I have to pay for it? Now, right? If I buy a futures contract on water that expires in 5 days' time, when do I pay for it? 5 days' time. So are they the same or are they different? They're different, right? If I purchase a futures contract today that expires tomorrow on water, and I buy a bottle of water today, are they the same or different? I can either buy a bottle of water today, or I can buy a futures contract on water that expires in 1 day's time. Are they the same or are they different? If I buy the water today, when do I have to pay for it? When I buy the futures contract that expires tomorrow, when do I have to pay for it? So they're the same or they're different? Different. If I purchase a bottle of water today, or purchase a futures contract today that expires today, are they the same or are they different? They're the same. So that's the point. At the date that the futures contract is going to expire, there is no difference between you purchasing a futures contract or purchasing the spot, because you have to pay for it today. There is no difference. If there is no difference, then the price must be the same. So we refer to this, we call this the law of one price. If you've got two items, 2 bottles of water, right? If you go to a supermarket and you see one bottle of water costing $3, and then next to it there's another bottle that's costing $3.50, you think something must be wrong, right? If they're identical in every way, they have to be priced the same way. So it's the same with any other type of contract. Just because one's called a futures contract and the other's called a spot, if they're offering you exactly the same thing, they must be priced the same. The law of one price. So that exists at the day that the futures contract expires. In other words, both the spot and the futures must converge to each other at the final termination date of the contract. It cannot be anything else. They have to be equal to the same thing. Okay. That's going to help us later on when we start pricing futures contracts. Now, another thing that I talked about last week is the difference between price and value. So when we talk about the option premium, that's the same thing as saying what is the price of the option? What is the value of the option? They mean identical things. If you have to calculate the value of an option in the exam, that's like calculating the price. That's not the case for futures markets. It's actually only for futures markets that I can think of that there is a difference between price and value. Price, as I referred to it last week, is the contracted rate of future purchase. What does that mean? It tells us that if the futures price for a bottle of water is $3, it's telling me, and I agree to go long on one bottle of water, I am contracted, I'm obliged to pay $3 in, let's say, 5 days' time. That's my contractual agreement. It's a contracted rate of future purchase, how much I have to pay in the future for the water. It tells me nothing about value. It tells me nothing about what the current value is of the futures contract. In fact, the value is 0. Why is it 0? When I start off a position, if I purchase a water futures contract today, the value to me is 0. How is that? That's a good start. Yes. Am I paying anything? No. Am I receiving anything? No. Well, if I'm not paying anything and I'm not receiving anything, then how can there be any value, right? So the value is basically equal to 0. All forward and futures contracts start off with a value of 0. Okay. Now, to understand what happens after that, we have to look at some notation. So capital V and capital F stand for the value of forward contracts and the price of forward contracts, respectively. And therefore contracts that start at time 0 and they expire at time large t. Small v and small f refer to the value and the price of futures contracts. So one's for forward contracts, the first 2 are for forward contracts and the second 2 are for futures contracts. So the way in which we work out value is basically very similar in how we calculate a profit. Basically, you can look at it as if you're looking at the profit from your position. Although technically speaking, there's slight differences between the two. If I go long, I purchase a forward contract today at time 0 that expires at time large t, and I want to know what the value is going to be at the termination date, then this needs to be changed here. This is a little bit wrong. This 0 should be large T as well. Should be large V, brackets, large T, comma, large T. You might want to change that. So if I'm asking the question, what is the value of the futures contract at the value of the forward contract at termination? It's going to be equal to the final spot price minus the price you paid for the forward contract at time 0 when you took out the contract. How can I say this? Well, we know that the final forward price will be identical to the spot price, right? We just highlighted that previously. They have to be equal to the same thing. Forward and futures prices have to be equal to the spot price at the day of termination. So, the difference between these two prices is in fact what value is. So then this leads us to another question. How do I work out value before the termination of the contract? So the easiest way for me to show you is through a little example. Okay, so we've got time here on our horizontal axis, and we'll have prices on our vertical axis. Let's say at time 0, you decide to take a long position in a forward contract. So our forward contract price is at this point here. We also know that it's going to terminate at some point, let's say at time large t. And we want to know what is the value of the forward contract before expiry. Let's say at this point in time here, small t. We want to know what it is. So, let's say prices for the forward contract have gone up. They've gone up to this point. And I need to know what the value is. Well, the first thing I can do is see if I can pretend to sell my forward contract. Really, it's very hard to sell forward contracts, right? Or get out of the position because they're very unique. But let's just say, for example, you can. Then what I might want to do is look at, I can't sell a forward technically, what I can do is go short on a forward contract, right? That's identical. So I could look at what the forward price is at that point in time. So it's going to be small t, large t. And the difference between the two, this bit here, technically speaking, could be my value, right? But what am I missing? If I go long on a forward contract at time 0, and then I go short on a forward contract at time small t, I'm saying that my value is the difference between the two prices. What's wrong with that? I mean, what I've said is sort of technically true, but I'm missing something important. What's the time bit? Explain. Not necessarily, because I'm now at this time small t. So if I can go long and then short, and I've gone long on this contract and go short on this one, then the value will be the difference. It is something to do with time. When do I receive this value here, V? When do I receive it? Small t? Large t, right? Always, always, you only settle, you only transact at the day of termination. So even though technically speaking I should be making money, right, because I have gone long on a forward contract that I paid less for than I can go short on another forward contract for, right? I should be able to make money. But do I receive the money at time small t? No. I get paid at time large t. So, what happens is that I have to work out a way of discounting the value for a certain number of days. How many days? It's going to be large t minus small t. Okay, so that's basically the answer. So if we have a look at the slide, you'll see that the equation I've written down here explains what it basically is. And again, there is a mistake in the notation. It should be capital V brackets small t, right? Capital V brackets small t, comma, large t. What's the value of the forward contract at time small t? It's going to be equal to the current forward value at time small t minus what it was previously when I took out the position at time 0, discounted for large t minus small t. So because everything is settled at the termination date, we have to discount the value that it looks like I currently have for a number of days. Okay, let's look at an example, and then we'll take a short break. Let's say that I have gone long on a forward contract that expires in 45 days' time, and the current forward price is $200. The risk-free rate is 10%, and 20 days later, I know that the price for the forward contract is $208. What is the value? The value is going to be 208 minus 200 discounted at 10% for another 25 days. Why? Because in 20 days' time, there's another 25 days remaining before the contract matures. In other words, the current value of the forward contract is $7.95. Okay, so we'll just take a short break, let's say 5 minutes, and then I'll continue on. Okay, so moving on from there, if we look at the value of futures contracts, it is slightly different. Here let's place on the vertical axis value and time on the horizontal. This is plus, this is negative. Then basically on any given day, the value of a futures contract might rise during the day before falling down to 0. Or it might go down a lot. Whatever the case may be, at the end of the trading day, the value of the futures contract returns always to 0. Why is that? So, at the start of the trading day, the value of a futures contract is 0. Then during the trading day, the value of the futures contract changes as the price changes. But at the end, it goes back to 0. Why? Yes, very good. Excellent answer. And what is it about daily settlement that makes it go back to 0? Clearly the answer is daily settlement. The simple, that's the main bit. The next bit to answer is very simple. Well, if you've made money during the trading day, what happens at the end? At daily settlement?
You get some money in your account.
That's right, you'll get money in the account. So if you get money in the account, you've been paid, right? So therefore, value goes down to zero because what? You've been paid, right? You can't say like you've worked for some shop for the day, and the shop owner pays you money, and then the next day you go back and say, I want some more money. And then the shop owner says, well, I paid you already, right? Once you've been paid, then it's equal to zero. You've netted off your position. So every single day, of course, if you've made money, it's deposited in your trading account, not your trading account, in your margin account. And if you lose money, then you have to pay it. So once you've paid your debt, it goes back to zero. It doesn't stay at a negative value. So the reason why the value of a futures contract always returns to zero after daily settlement is because any money that you've made or lost is transferred, and therefore your net balance returns to a zero value for that. That's the answer to the question. And that's what I've got down here. One day, and you may not be able to answer this, but I'm going to ask it anyway. One day before expiration, the futures price will be equal to any forward price that has identical contract specifications. In other words, a forward is equal to a futures contract one day prior to expiration. It is also equal to the forward contract is also equal to the futures contract on the day of expiration as well, for that matter. What's the reason for that? I'll give you a clue. It's what we've just talked about. So, there is one major difference between forward and futures contracts. That major difference in terms of how they operate is that one has daily settlement and the other doesn't. Daily settlement leads to a difference between the value of futures contracts versus the value of forward contracts. It will also, of course, believe it or not, have a small impact, of course, on the price as well. Why? Because prices take into account basically how much money you've got to have available to make these margin calls, etc. So, one day prior to expiration is when daily settlement finishes. There is no daily settlement the day before the expiration of the futures contract. If there is no daily settlement before one day before the expiration of the futures contract, then there's no difference between the forward and the future. They're identical. They're identical in every matter. And if they're identical, then due to the law of one price, they must be worth the same. So it's applicable to both value and price are going to have to be equal to each other. So that's the answer to the question. I don't think I mentioned the fact that daily settlement finishes one day prior to expiration, so it was a bit of a tricky question. Okay, so we're now ready basically to start looking at how do we design a forward and a futures pricing model. And it's probably again easier for me to show this through an example on the document camera. Right. So the example I'm going to give you is a little bit silly because I did have a student many years ago tell me that it's actually incorrect because his parents were poultry farmers and my example all is about chickens. So it is a little bit silly, but it does get the message across. So this is what we're going to do. You are all poultry farmers. You basically look after chickens and you sell them. I am KFC, right? So I want to purchase chickens. In particular, I've got a new marketing strategy because recently my sales have gone down because someone discovered that there was a fried rat in the bucket, right, when it's supposed to be just chicken wings. So I've got bad publicity. I need a way of beefing up chicken sales. So I'm going to hold an annual chicken day where everybody goes out and buys chickens. So in preparation for that, I must basically make sure I've got enough chickens to sell. So I'm coming to you and I'm going to try to make you an offer. The current price, so let's call this the spot price. So S is not relating to stock, it's just spot, right? S-P-O-T. The spot price today, times 0, for one chicken, let's say, is $1. So I come to you and say, look, in 20 days' time, in one business month, I'm going to have annual chicken day. I want to make sure I've got enough chickens to sell, to fry up. So I'd like to offer you a deal where I will guarantee the sale of your chickens for the current market price of $1 a chicken in 20 days' time. Are you happy to accept, or are you going to reject that offer? Is this a good deal or a bad deal?
Bad deal.
It's a bad deal. And the reason?
Because I can sell chicken $1 now.
Oh, that's a very good point, right? Very good point. You could say to me, well, hang on a second, why would I want to sell them in 20 days when I can sell them now? So then I'll say, well, what difference does it make to you? What difference is there? It does make a difference. What's the difference? Why would you rather sell them now than later?
Because I can put the money into the bank.
That's right. That's right. So one thing that I have not accounted for, that I'm trying to rip you off, I'm trying to get a good deal for myself, is something that we refer to as the interest foregone. So if we're designing a futures price, because that's what we're doing now, or a forward price, same thing, the futures price for chickens today are going to have to be equal to at least, right, what the current spot price is, right? I think we're all happy with that, okay? The base is going to be the current spot price. But then you can say, well, I'd rather sell my chickens now than later because I'm losing money. If I sell the chickens now, I can get my $1 per chicken, put it in the bank, earning interest. So what we need to account for, and this is how I'm going to do it, I'm just going to call it I times S. So basically, the interest multiplied by the principal value, that's the interest foregone. How much money I'm losing for not selling the chickens now, but in the future. Okay. Interest foregone. What else? Is there anything else you can argue? Come on, you're looking after these chickens. You must basically you want a higher price from me, right? So what else can you argue that you need to be compensated for to increase the price you're going to get? Sorry? Excellent. You need to feed the chickens, right? You need to store them somehow. You need to make sure they don't get eaten by foxes or other type of animals, right? So these are things you have to be prepared for. So another thing that we can add, of course, is, let's call this a little s, and that little s represents storage costs. Okay. So, together, if I have interest foregone plus storage costs, this is referred to in the market as the cost of carry. What is the cost of carry? Basically, it is the fact that there is a cost for carrying the good. If you own the chickens, you own the goods. But there is a cost for you holding them. The cost is the interest foregone, because you'd rather sell them now and earn money, put it in the bank, and you have to look after them. So literally, it's telling you what it's referring to, the cost of carrying the goods. Now, there is a cost for carrying any type of instrument you can think of. Obviously, some commodities and some financial futures have different type of costs associated with them. So let's go through some examples. Does stock futures have a cost of carry? Yes, what would that be?
Storage cost.
There is no storage cost for stocks. Do we have storage costs for financial futures? No. There is no cost. Is there interest foregone?
Yes.
There is. Okay, good. So there is always interest foregone. In any type of futures contract you can think of, there is always interest foregone. However, whether there is storage costs or not really depends on what you're looking at. It's not so clear-cut either sometimes. Technically speaking, only when you have interest foregone and storage costs do you have cost of carry. However, in reality, nowadays, when you talk to traders, they will constantly talk about carry trade. Carry trade basically is referring to the cost of carry. And they sometimes are talking about financial futures. So really, the cost of carry nowadays is used for just simply referring to interest foregone. Because financial futures don't really have cost of carry. Cost of carry is storage costs and interest foregone. But this is slang, they use it for everything nowadays. Okay, let's look at another example. Let's say we're looking at gold futures. Does gold futures have interest foregone? Yes, yeah, of course, anything has. Gold, we don't have to talk gold futures, gold has interest foregone. What about storage costs? Yeah, you have to store it somewhere safe, right? You can't just leave it outside, because, everyone's going to start taking it. Okay, what about oil? Does oil have storage costs? Okay, that's a reasonable answer, but in fact, it's actually incorrect. The answer is no, it does not have storage costs. Why is that? Because it's in the ground. So, the spot price is when it just comes up from it, right? It's a speculative price of what's in the ground, how much is available. So there is no storage cost. The reason I'm highlighting this is because sometimes it's not clear if there is a storage cost or not. You need to research it. Depending on what contract you're trading, you need to look at the spot, whether it has a storage cost or not. It's not so obvious. But at the end of the day, financial futures, by and large, do not have storage costs. Okay. So far, so good. Now, I can, however, make my model a little bit more complicated. I can say, it is true that you have to pay for storage costs for 20 days, and you also are going to lose money from not having pocketing the cash now and putting it in the bank, so there's interest foregone. But there is an advantage for you carrying the good. There is a cost of carry, but there is also a benefit from carrying. What is that benefit in your case? I'm going to call it the squiggly X, a chai here. What could be a benefit of holding on to the chickens? I'll give you a clue. What do chickens do? They lay eggs, right? They lay eggs. So if your chickens are laying eggs, you can make money from it, right? So this is referred to as the convenience yield. The convenience yield is the yield, the benefit, from holding the good, the convenience from holding the good. You have a cost of carry, and you also have a convenience associated with it, a benefit. That convenience yield, in the case of chickens, of course, is laying eggs. The reason I said at the beginning that my model's a little bit wrong is because I had a student whose parents were poultry farmers, and he said, no, this is all wrong because chickens that are used for breeding for meat are different from laying eggs, so the model doesn't function. So, okay, fine. But nobody people's going to know that, so it's a good example to go through. So, of course there is, generally speaking, if you've got chickens, they will lay eggs, and therefore there is a benefit if you can sell them. So I could say, it is true, you have to pay storage costs and interest foregone, there is cost of carry, but you're making money for 20 days from the chickens laying eggs. Therefore, at the end of the day, I should be able to reduce the price of the futures contract. So, this leads to something quite interesting. Pay attention to this, if the cost of carry is larger than the convenience yield, the market is going to be in what we call full carry. Full carry. So let's say the cost of carry, let's abbreviate it to this sign here. So I'm saying if the cost of carry is bigger than the convenience yield, then the market is in full carry. Sometimes it's also called contango. What do you think is going to happen if the market's in contango? If the cost of carry is bigger than the convenience yield, will the futures price, look at the equation, will the futures price be above or below the spot price? Above, right? Can you see that? It's quite clear, right? If this is larger than this, then the futures price must be bigger than the spot price. So when futures are above spot, we say the market's in full carry or contango. On the other hand, if the cost of carry is smaller than the convenience yield, we say that the market is in less than full carry. And this is also called backwardation. The reason we call it less than full carry, as the name suggests, is that the convenience yield is larger than the cost of carry, implying it's taking a bigger role. And therefore, if this is bigger than the cost of carry, the futures price has to be below the spot price. Okay, so those are the two possibilities. What drives the futures price to be above or below the spot price primarily is determined by comparing the cost of carry with the convenience yield. But not completely. There are other factors that also play a role. So I'm going to talk about those in a second. Before I do that, however, let's just talk a little bit more about this convenience yield. Can someone tell me what is the convenience yield for holding stocks? Dividends, right? If you hold the stock, you can receive a dividend. If you hold a futures contract on the stock, you do not get the dividend. The dividend is only paid to the stockholder. Same with bonds, right? You receive the coupons, right? You receive the interest premiums, whatever. What about gold? Is there a convenience yield for gold?
No.
This is a tricky question. For most commodities, most commodity futures contracts, for most commodities, there is no convenience yield. So if you think about wheat, orange juice, rice, you name it basically, oil, there is no convenience yield from it. You cannot derive an income just by sitting on oil, right? You have to basically sell it to make money. You can't just sit there. You can sit on the stock. You own the stock, you just wait and you get money because many stocks pay dividends, right? Okay, gold is a tricky question. That's the reason I raised it, because technically speaking, it does not pay any quantifiable, any measurable dividends. But there is an advantage from holding it. People buy gold when what happens? Yeah, when there's a crisis, when you have no confidence in the currency you're holding, or the country, or the economy, so everybody starts buying gold, right? There is a convenience yield, because if the whole world, explodes, then you can still trade with gold. People always accept that. So there is a convenience yield, but can you measure it? No, it's hard to measure. So the answer is sometimes it's not very clear. There could be a convenience yield, but you can't really measure it. When it comes to modeling, we ignore that issue. So when it comes to modeling gold, we won't say there's a convenience yield. We'll say there's zero convenience yield, because we can't price it, right? We just ignore it. There are other, however, things that we can look at. So far we're living in what we call a risk-neutral world. I'm not assuming that basically there's any risk transfers that are occurring. But let's say there is. Let's say I am a bread maker. I'm a baker. I make bread. And I need wheat for my bread. I am worried that I don't know what's going to happen to wheat prices in the future. So if I'm making a deal with you, and you're the farmer, you're going to provide me with wheat, would I be willing to pay a little bit more or a little bit less for the wheat in the future? Are you sure? Let's say today the price of wheat is let's stick with our example with chickens, okay? I'm KFC, you're the poultry farmer. I am a bit worried that I'm going to be paying too much for chickens in the future, right? Chicken demand will go up if I'm very successful with my marketing. So, would I be willing to sign a contract with you now for more or less than $1? I want to be guaranteed that I can get the chickens, right? Would I be willing to pay more or less than the current price? More, right? I am actually transferring risk. There's what we call a risk premium. The risk premium is the following. I don't want to take on the risk I'm going to be paying more than $1 a chicken in 20 days' time. Therefore, I'm willing to make a deal with you to pay $1.10. I am transferring my risk to you, and in return, I have to pay you 10 cents more per chicken. That's a risk premium. Okay. It could also work out the other way around. There could be a risk discount. Let's say you have heard that there might be another bird flu outbreak. And if there's a bird flu outbreak, people are not going to buy chickens in the future, and you might find that chicken prices go down. So, when you're negotiating with me, you might say, you know what, don't worry, I will be willing to sell my chickens to you for 90 cents a chicken in the future. Why? Because it doesn't matter if chicken prices go down, if nobody's buying chickens. I, KFC, have to buy your chickens for 90 cents, right? So it's true, you're losing 10 cents a chicken, but you're transferring your risk to me. And you're willing to do that for 10 cents. So we can add or potentially subtract a risk premium or discount. So this risk premium or discount is unknown. And this can also affect whether the market is in contango or backwardation. So this could be positive or negative. Finally, The last thing, and I won't put in another, well, I can, you know. I'm going to put something in which you should all know. What is this representing? What's this squiggly E? I'll give you a clue. Quantitative methods. It's an error term, right? Some noise. This error term could also be due to speculation, right? Prices for futures contracts move up and down also simply because of speculation. People think prices are going to be higher or lower in the future. Pure speculation. So the reason I'm putting all this in is because that's what the final model basically looks like. The value of the futures the price of the futures contract today is equal to the spot price today, plus the cost of carry. The cost of carry consists of two components, the interest foregone plus the storage costs. In addition, there may be a convenience yield. This convenience yield will reduce the price of the futures contract. The convenience yield could be things such as the dividend payment, right? Or the fact that chickens are laying eggs and you can make income from that. Any form of income is a convenience yield. Then we also have a risk premium or a discount. This could be positive or it could be negative. And finally we have some noise, and this noise comes from speculation. This altogether will determine if the futures price will be above or below the spot price. At the end of the day, all things considered, most people would say really what drives the market is not so much the risk premium and speculation, it's simply the fact, is the cost of carry bigger or smaller than the convenience yield? That's generally what mostly drives the market. So the majority of the time, what do you think is true? Are futures markets in contango or are they in backwardation? Based on what we've just covered, what do you think is the case? Particularly for commodity futures. For commodity futures, what would you expect to see most of the time? Contango, right? The cost of storing the asset plus the interest foregone will generally be higher than the convenience yield, which mainly is non-existent in commodity futures. So for most commodity futures, the market's in contango. For financial futures, it depends how high the interest rate is. If the interest rate is large, then you have contango. If the interest rate is low, then you probably have backwardation, or less than full carry. Okay, so if I have a look at the slideshow, I present exactly the same thing as I've just demonstrated in my on the document reader, but the other way around. So here I'm saying, what's the current price of the chickens? The current price of the chickens is what it will be worth in the future, minus the storage costs, minus interest foregone. Then I add expectations. I don't know what the future holds, so now I've got the expected final spot price. And then I add a risk premium. So this risk premium, this actually should be a plus or negative sign here. It could be positive, it could be negative. So this is basically my model. The spot price today is equal to the futures price in the future, minus the storage costs, minus interest foregone, minus the risk premium or discount. And together, storage costs plus interest foregone equals the cost of carry. When futures prices are above spot prices, we have contango. When futures prices are below spot prices, we have backwardation. Sometimes it's also called less than full carry, and also sometimes it's referred to as being inverted. When the market only consists of speculators, there are no hedgers, then technically speaking, the current futures price should equal the expected final spot price. Sounds a bit strange, but that's what it's basically saying. There should be basically whatever the futures price is today is what people are expecting the final spot price to be in the future. However, if there is a risk transfer, like I explained in my example before with the chickens, then sometimes you might find at least with the risk premium, the expected final futures price, or the final spot price, the same thing, is larger than the current futures price. So depending on whether there's a risk premium or discount, it may be larger or smaller, in fact, could go either way. When hedgers go short on futures, they transfer risk premiums to the speculators who go long on the futures, and you end up with this. The expected final spot price is equal to the current futures price plus a risk premium. So I'm just repeating the same thing that we've looked at before. And this basically leads us to 4 different ways in which we can summarize the futures market. It's important to highlight the following. The first 2 are factual pieces of information. I can go to the market and I can determine straight away, is the market in contango or is it in backwardation? I just compare the futures with the spot prices. Very, very simple. The next 2, however, are different. These are what traders or investors are thinking the market is in. If I say the market is in normal contango, it means I personally think the current futures price is higher than the final spot price. So if I think that, if I believe that, what does that mean? What am I saying? What am I saying is going to happen to the market? If I believe that the current futures price is higher than the final expected spot price, what am I expecting to happen in the future? Yeah, I'm expecting the futures price to go down. If I say the market's in normal backwardation, then it's telling me that the current futures price is below the final expected spot price. It's telling you I'm thinking futures prices are going to go up. So the first 2 are facts. They're factual pieces of information you can find out. The second 2, normal contango and normal backwardation, are just simply what people are thinking is happening in the market. It's a way of just talking. It's not necessarily true. It's just what people think. So, as this course primarily has focused on the equity market, I've got an example here with dividends. Dividends, as you now know, are a convenience yield. So if we want to work out an equation for a futures contract on stock, it'll look like this. The futures price today is equal to the spot price plus the interest foregone, that's this here, 1 plus r to the power of t, right? This is the interest that I'm losing if I don't sell the stock now, minus the convenience yield. Notice there is no storage cost, right? I've deleted that. So it's 3 components. I've got the spot, interest foregone, and the convenience yield. So another way of expressing it, of course, is in this manner here. The futures price is equal to the spot multiplied by the exponential function to the power of the interest foregone minus the dividend yield. This equation here is identical to the previous one. The only difference is this: in my first example I've got discrete compounding, and in the second one I've got continuous compounding, right? Otherwise they're the same thing. As you should know of already, in the course we switch between the 2, between continuous and discrete compounding and discounting, but in reality we should only use one. Which is that? Continuous, right? Continuous is what you should really use all the time. So, I'm told the stock index is at 100, the interest rate is at 8%, and the dividend yield is 6%. Just knowing these 2 pieces of information, that the interest rate is at 8% and the dividend yield is at 6%, I can tell you straight away if the market's in contango or backwardation. Which is it? Contango, right? Has to be. The cost of carry, which is just the interest foregone, is larger than the convenience yield. So just by looking at these 2 pieces of information, I can tell straight away straight away whether there is a contango or backwardation. This is useful to know. Why? Well, you might have an exam question saying, is the market in contango or backwardation? And you think, oh, okay, I've got to work everything out, right? I've got to work out what the futures price is. No, you just compare two numbers. So sometimes there's a quick way of solving a problem. Okay, let's say the expiration date for the contract's in 60 days' time. Then what's the value? Well, what's the price of the futures contract? It's equal to, well, 100. That's the spot price multiplied by the exponential function of 8% minus 6% multiplied by 60 days over 365. I get $100.33. So, yep, the market is in contango. The futures price is above the spot price. So the final slide I've got here for today asks the question, what is going to be the difference between two futures contracts if they're identical in every way except for time to maturity? So here we've got our first futures contract and it expires at time T1, and the second futures contract expires at time, oops, done that wrong already, time T2. So, the question is, what will be the difference in the futures prices? Well, all things considered, if we think markets are generally in contango, commodity futures at least, what futures contract will be worth more, will be priced higher, sorry, F1 or F2? F1 or F2? 2? 50% chance of getting it right here. Yeah, most people saying 2. And the reason? What's the reason? Yeah, go. Exactly, that's it. So I'm very glad you answered that question correctly. It's a very good answer. That some people start thinking, oh, because they've just done options, oh, there's time value of money or something like that, right? There's no time value of money with futures contracts. The reason why, generally speaking, you expect the futures contract that expires later to be priced higher is simply because there's going to be greater cost of carry, right? So the difference between the two is going to simply be the difference between the cost of carry for the second futures contract versus the first one. The second futures contract requires you, the holder. It's like me saying, well, let's change the contract for the chickens not to be delivered to me in 20 days' time, but in 40 days' time. Well, your storage costs have now just doubled, right? Your interest foregone has now just doubled. So the difference between the futures contracts, which are the same in every way, except for time to maturity, is the difference in the cost of carry. And that's basically what I've got down here. The difference in futures prices will be the difference in the cost of carry. Okay, so that's it for today. Thank you very much, and I'll see you next week.